We're starting today's deep dive with a story that sits at the intersection of artificial intelligence, systemic risk, and central bank credibility. Because the Federal Reserve has been flying partially blind on one of the most consequential artificial intelligence deployments in financial history. The Fed flagged critical vulnerabilities in Anthropic's Claude Mythos preview model months before mid-July of this year. Yet, as of that same date, the central bank still lacked direct access to conduct its own stress testing and threat assessment. That is not a minor bureaucratic hiccup. That is a governance gap with real systemic implications, and markets are only beginning to price the full weight of it. Here is the core fact. The Federal Reserve identified critical security vulnerabilities in Anthropic's Claude Mythos preview artificial intelligence model and raised the alarm. But despite doing so, the Fed had no direct access to the model as of mid-July 2026. Other institutions, both private and public, were actively patching those same security gaps while the central bank responsible for monitoring systemic financial risk sat on the outside. The governance consensus heading into this year was that major regulators would maintain real-time parity with private sector institutions on frontier artificial intelligence evaluation. That assumption has now been demonstrably broken, with the access lag running significantly behind deployment velocity. The deeper issue here is structural asymmetry. Financial services firms, from the largest money center banks to fintech-native lenders, are deploying frontier artificial intelligence models at a pace that regulators simply cannot match without direct, unrestricted access to those very systems. When the Fed cannot independently stress test a model it has already identified as potentially dangerous, the entire framework of systemic risk oversight loses its teeth. Think about what that means in practical terms. The institution charged with maintaining financial stability is relying on second-hand reporting from the same private sector players it is supposed to be supervising. That is not oversight. That is regulatory capture by default, and the market should be paying close attention. Let's talk about who carries the most exposure here. The financial sector broadly, tracked through the financial sector, faces a dual headwind: rising compliance costs and potential artificial intelligence implementation delays that will pressure operating margins. JP Morgan, Bank of America, and Goldman Sachs are the names to watch most closely. All three are deeply embedded in artificial intelligence-assisted risk modeling, trading, and credit underwriting, and any erosion of governance credibility raises the tail risk around their artificial intelligence-dependent revenue streams. Regional banks like KeyCorp face elevated uncertainty around what new artificial intelligence governance requirements might look like. On the infrastructure side, NVDA sees mixed signals. Regulatory scrutiny weighs on near-term sentiment, but underlying demand for artificial intelligence compute remains structurally intact through this cycle. There are three specific gauges to monitor as this story develops. First, the 10-year Treasury yield is sitting at 4.63%, up 0.65% today, already reflecting persistent uncertainty around Fed credibility and institutional competence. A move above 4.75% on further regulatory confidence deterioration would be a meaningful signal of broader repricing. Second, the VIX is at 17.66, up 3.58% on the session, elevated but not yet alarming. A break above 20 would confirm that artificial intelligence governance fears are spilling into broad risk-off sentiment. Third, and most critically, watch for any formal regulatory action announcements from the Fed or Treasury around artificial intelligence model access frameworks. Those catalysts could reprice financial services names sharply in either direction. The bottom line is this: the Fed's months-long access lag to Anthropic's Mythos model is not an isolated administrative failure. It is a systemic warning that artificial intelligence governance infrastructure is dangerously asymmetric with deployment velocity across the financial system. Markets today are showing resilience, suggesting investors are still separating near-term regulatory noise from longer-term artificial intelligence opportunity. But any further evidence of institutional capture or widening oversight gaps could trigger a meaningful revaluation in financial services and discretionary tech names. Monitor Fed statements and regulatory access announcements closely. That's the single most important catalyst in this story. That is the one story that matters most today. Full breakdown is up. If this kind of institutional-grade market analysis is what you need every trading day, hit subscribe and turn on the notification bell. We break down the stories that move markets before they move your portfolio.